Okay, finally, this is the final video on the statement of cash flows. Um, in the first video, I gave you the format and reviewed it. The second video. In the second video, I went over these calculations. You may want to go back over the second video, but from the fixed asset and accumulated depreciation accounts, I computed the sales entry, or they gave you the sales entry, and the cash from sales is going to go to the investing section, the loss in the operation section. The purchases, the cash you paid for purchase is going to go in the investing section. Cash outflow, it's credit to cash otherwise, obviously, and you're going to add back depreciation expense in the operation section. And then I went through the investment account, and you're going to have a cash inflow in the investing section, and you're going to subtract out that gain in the operation section. And then finally, always reconcile retained earnings. Okay, so what I'm going to do here, it's going to be a quick video. I'm just going to go ahead and fill out the statement of cash flows. Now, the problems that you get in real life and on the CPA exam, and for me, you're not going to get you're not going to fill. I'm not going to give you a format to fill in. You have to figure it out yourself. But this is kind of review. Start with income. Okay, then we've got changes in three assets. Okay, and the easiest way to do this is assets have the opposite, or the adjustment for assets is the opposite of the direction of their change. So the easiest way to capture that is you look at accounts receivable. Accounts receivable went up. So just take the early, or the first year and subtract out the most recent year, and that will give you, it went up by negative 90, so you subtract out by 90, and you do that. So do that for accounts receivable, which is, wait a minute, I make a little mistake here. Now do that for inventory. Do that for inventory. Inventory went up by 54, so you need to subtract it out. That's the effect. And do it also for inventory, which, for not inventory, for other current assets, I think, or for prepaid expenses, except that seems to have gone up, so you're going to subtract it out. Prepaid expenses went down, so you're going to add it back. Okay, so that gives you the a change to current assets. Then go down to current liabilities. Current liabilities their change is in the same direction. So we just have two current liabilities. One is accounts payable, and that went up, so we added it back. And then accrued liabilities apparently went down, so we're going to subtract that out. Let's see here. Accrued liabilities. Went down by 7. Okay, and just for our class, this is obviously wrong, but in these examples that we use in class, I'm just going to consider deferred income tax to be a current liability. It's wrong, but just I'd rather go through we'll do deferred income taxes in a later chapter anyway. So, but let's just treat it as a current liability, and I'll make that assumption in the example I give you too. So that's 3,000. Okay, and then the only other things you've got depreciation expense and a gain and loss. Now you always add back depreciation expense, so that's going to be equal to the depreciation expense that I figured out right there. There's your depreciation expense, 60,000. The gain on the sale of equipment is going to be on the sale of long-term assets is going to be subtracted out. So you're going to subtract out that gain. You always subtract out the gain, add back the loss. Okay, the loss is going to be added back. That's the loss in the sale of equipment of 6,000 right here. And then finally, we'll just add up the operations section of the statement of cash flows, starting with net income, going down to the loss on sale, and you should get 21,000, and you do. Now these next two sections are relatively short usually, at least in textbook problems. Sale of long-term investments. We had 2 sales of long-term assets and 1 purchase of a long-term asset. So we didn't have any lending activities. Look out for those. So the sale of long-term investments is right here. 50,000 came in from selling long-term investments. Was it 40 or 44 came in from selling the asset right there. That 44 right there. And then purchase of equipment is going to be a negative. That's the $200,000 purchase of equipment right there. And we'll just go ahead and add these 3 numbers up. We get negative 106. That looks good. Okay, then finally, we've got financing session. I already put dividends in there apparently. Let's see what we got here. I want to make sure I'm getting it from the right place. Yeah, I'm getting it from the right place. Negative 28. For each purchase of stock is when you buy back stock, it's obviously a negative. And let's do it this way. That's going to be equal to the difference in the stock account. So if you look at the common stock account, it went down, which means you bought it back. It went from 600 to 595. So it's going to be equal to that 595 minus the 6, which gives you a negative. And then finally, the sale of bonds payable. And I'm just picking these things up through the change. I'm just looking, going down and reading the financial statements and finishing reconciliation. Bonds payable went from 100,000 to 200,000, which means you issued bonds. So you had a debit to bonds payable, or debit to cash, credit to bonds payable. So you borrowed money. So it's that minus that. Okay, which means that your cash flows for financing activities are 28, negative 28 out, negative 5 out, 100 out. That gives you 67. And if you add the cash flows from operations, cash flows from investing, and the cash flows from financing activities, you end up with negative 18,000. And there it is. And let's just check this out. That negative 18 should obviously, if you be equal to the change in cash. The change in cash is 33 minus 15. Well, it's actually 15 minus 33 gives you negative 18. So they do equal. Anyway, basically what I did is I went down and I went through all my current assets and liabilities. Then I went through my plant and equipment, and then after that, I just looked at all these accounts, having done all the investment and retained earnings summaries. I went down through all these accounts and made sure that they were all reconciled. So if you think about it, everything here, accounts receivable, inventory, prepaid expenses, were all in the statement of cash flows. Changes to long-term investments also. Assets and accumulated depreciation, I did those all right here. You accounted for all those changes. Counted for anything current, bonds payable, I accounted for at the end, and common stock. And I'd already accounted for deferred income tax, current asset. And finally, I just reconciled the retained earnings account. The retained earnings account is reconciled because the 2 items that change retained earnings, net income and dividends, are the 2 items. One starts the statement of cash flows, there's your net income, and the other one, dividends, is always near the bottom of your statement of cash flows. That reconciles it. Okay, so that's just sort of a review exercise. This is the last of the video. It's probably the shortest one. I'll put it up, and this will be the lecture, actually, part of the lecture on the 3rd of February. Okay, so here we go. Have a good night. Bye.